Okay, what are the questions you want to discuss? First thing I say, I think we didn't discuss spot trade in this class, isn't it?
Yes, sir.
So you won't be able to answer this part. But the first part, you should be able to do that. Okay, in the section B, what are the questions that you want to discuss?
Question number 2.
2. You have purchased 1 million face value 9.5% Sri Lankan government bond maturing on 15th June 2023, settling on 15th December 2019. Calculate the price that you pay if you required yield is 9.75. Okay. What is the difficulty in that?
In the second B, that modified duration.
Calculate the modified duration of the.
Yeah. For that one, we have to find the metal duration first. So
yes,
I don't have an idea to how to find that metal duration.
So for to calculate the Macaulay duration, what can you see the board now? For the
yes.
You can see the board.
Yes, sir.
Yes. Okay. To calculate the, or even to calculate the price, what we need I1, I think it's 2019 December to 2023. What's the maturity date? 15th June 2023. So now we are in, you purchased it in December 2009. So next coupon will be in June 2020. Likewise, how many cash flows? Remaining cash flows. There are only 7 cash flows. This is one of the things you have to decide. Timing of the cash flows. Is it correct?
Yes, sir.
Okay. Then what is the next step? What else you need in front of these dates? To calculate the price, what do you need?
So this is a semi-annual one, no?
Yes, it's a Sri Lankan government bond, so it's a semi-annual. That's why we get.
Sometimes they will tell that. Sometimes they won't tell, no? It's the same,
Yes. So timing of the timings. Okay. Now what else we need to calculate the price?
Sir, government, Sri Lankan government bonds are not always semi-annual, no?
So listen.
Always? Okay.
So what else you need to do the price? Calculate the price.
The coupon amount.
Yield.
Cash flows. Coupon amount. What are the cash flows? How do you calculate the coupon? How do you calculate the coupon amount?
S value into coupon rate into divided by 2.
Why do we divide by 2?
The semi-annual.
It's because of the semi-annual. Otherwise, this is the coupon rate. Okay, then what is the coupon amount? $1 million into 9.5. That's the amount. Is it correct?
Yes, sir, correct.
Okay, now these are the coupon amount. Every 6 months, we get this. What about the last one?
1 million plus 47,500.
This is the last coupon. Then what do we need?
Now we can find out the price, bond price.
Oh,
From that sum, or we can, without sum, we can do that.
which sum? Sum of what?
We have to discount.
First, we have to discount all these cash flows. To discount, you need the discount factor. Or else you can straight away do the discount. If you have to calculate the discount factor, how do you calculate the discount factor? For the first one, it's 1 over 1.0475. 0.047, no, sorry, not 475, it's 9.75. 9.75 divided by 2. The yield of your required yield is 9.75. So then the semi-annual rate, it should be 9.75 divided by 2.
4.75.
Okay. 4.825.
So it's coming as 4.75. Is it okay if we get 4.285?
How do you get 4.75?
9.5 divided by 2.
Huh?
9.5 divided by 2.
9.5. What is 9.5?
9.7. Sorry, it's okay. This correct.
The yield is 9.75. We have to use that, not the coupon rate. So 9.75 divided by 2, 4.825. This is the discount factor for the first coupon period. For the
So
second,
when you divided 9.75, it gets as 4.87.
4.87. Sure. Ah, yes. 4.875. 4.875 to the power 2. Likewise, you can calculate the discount factor, or without calculating the discount factor, straight away you can calculate the present value. What is the present value? Either you multiply this cash flow by the discount factor, or directly 47,500 divided by 1.4875. This one, 47,500 divided by 1.04875 to the power 2. 47,500 divided by what? You can calculate the present values. Then you add these present values, you get the price. Clear? Then the question is the second part, how to calculate the modified duration. To calculate the modified duration, what do? You need to calculate the T into PV. That means 1 times whatever the figure you get here, you have to calculate this. Then the next one, 2 into 47,500 divided by 1.4875 to the power 2. You need not to do these things again because you have already done it at this part. So then what do? You add all these together, but it's not the Macaulay duration, whatever the figure you get here, you have to divide it by the price. Then you get the Macaulay duration. But to get the modified duration, what do you have to do? What is the relationship between Macaulay duration and the modified duration? What is the relationship between modified duration and Macaulay duration?
Modified duration calculates the 1% change in interest, how impact the bond price. Macaulay duration calculates the total impact.
My question is, what is the relationship between Macaulay duration and the modified duration?
So modified duration equals to Macaulay duration divided by
Modified duration equals to Macaulay duration divided by
1 plus y divided by k.
y divided by k. What is y? What is k?
YTM, yield to maturity. K frequency.
K frequency. So in this case, whatever the answer, this x divided by price, that's the Macaulay duration. It goes here. Divided by 1 plus 4, 8, 7, 5. Sorry. 1 plus 0.0487. Then you get the Macaulay duration. So, you know, there are two ways to calculate the price of the bond. But in this question, the part B asks you to calculate the duration, modified duration of the bond. So therefore, the best thing to use this method without without using the annuity equation. Because if you do the annuity equation, then again you have to do all these calculations for the Macaulay duration. Therefore, it's easy. You can answer both questions at once if you follow this method.
So can you kindly summarize these at once?
Yes. So if we summarize, what is the price of a bond? What is the price of a bond? If you explain it, what is the price of a bond? Explain it in one sentence.
Present value of the future cash flows.
The present value of the future cash
Cash
flows.
flows.
So then, what is price? Cash flows discount at the required yield. We should clear I. Okay, that's y over k. What is y? That's the yield to maturity or the stated yield. K is the coupon frequency. Second, coupon Likewise, cash flow in remember all these are just coupon, but this last cash flow is coupon plus face value. You have to remember that part. Then the question is duration. I call it duration. It is the weighted average time. What is the weight that we use? The weight is the present value of each cash flow. So divide by P. That is the Macaulay duration. What you have to do again. Two times here. 2 divided by 5 over k to the power 2. This is n times plus these things you can write it as present value 1, 2 times present value 2, n times present value 1. Same thing. When you discount the cash flow, you get the present value. You multiply present value by the time and add them together. Then you get the Macaulay duration. Then the modified duration. We use this relationship. Macaulay duration divided by 1 plus y over k. This is the summary. Anything else?
So how do we get that modified duration? What we divided? Can you tell it again?
Macaulay duration divided by 1 plus y over k. Y
No,
is
no. I means Macaulay duration.
Macaulay duration. This is the weighted average time. What is the weight? Weight is present value of the cash flow. This is the present value of the cash flow divided by P. That is the weight. See, all these things are present values, discounted cash flow amounts. It is multiplied by the corresponding time.
The previous thing and this thing same, no? The you.
Yes. We calculate the present value and multiply it by the time, add them together, divide by 5.
Sorry, sir. Required rate of returns and the market yields are same. No?
Yes. No, in a way. It's not necessary. Market yield is what market is giving you. But if you need more than or less than that, that's your requirement.
Sir, other thing is like what is the current yield? What's the relationship there?
What is the current yield? What is the current yield? Shall I erase this? What is current yield? Can someone ask?
The rate of return.
Rate of return. Current yield is say yes. In a bond we use various or few measures rate of returns. One is yield to maturity. The other one is current yield. This is a sort of simplified version. What is current yield?
So this is the yield that you are getting even without holding it to the maturity, right? Without the maturity yield.
Current yield.
Yeah.
Uh,
So you get the value of the bond divided by the rate, right?
value of the bond divided by the,
Rate,
what do you mean value of the bond?
as in the nominal.
The base value.
Yeah.
You divide base value by what?
The return of the bond, the rate of
So
return, whatever that is.
we are going to calculate a rate. If you divide base value by a rate of return,
All right, right.
what
Yeah.
you
Makes sense.
So coupon divided by the price.
it is the coupon divided by the as a percentage of the price that you paid. What is the coupon that you get? Right. That's a simple rate of return per year. What is your rate of return compared to what is your return relative to the price that you paid? But this captures only the coupon amount and no timing of that coupon. First coupon you will receive in few months, or maybe after 1 year. That timing is not captured here. So that's why it is called simple. It is a simple method, and that's why it's called current. For the current year, with the income, what is your rate of return? This is a very simplified version, but to price, this is the one we use. Yield to maturity. The other way we use to calculate the bond price is the spot rates, so which we didn't discuss. This is very used to calculate the bond prices. What about it? generally we can say we use yield to maturity. So remember this. What is current? Current yield and whatever the yield to maturity in the market are two different. Whatever the available or yield to maturity in the market and current yield are two different. So I hope you can interpret the modified duration figure. Any question on that? Any questions?
Have you got the answer for this modified duration?
Modified duration answer. Can someone tell the answer? Someone has raised the hand. If there's any question, you can ask now. So the answer would be 2.91. Remember, you have to do adjustment because when we do the calculation, you get the Macaulay duration as 6.1, but the maturity or the remaining maturity of this bond is just 2.5 years, 2019 to 3.5 years, 2019 and 2023. 21, 22. Sorry. What was the... Yes, 2019 to 2023, 4 years, that 3.5 years, not 4 years, because you are buying it on 15th December 2019. Maturity is on 15th June 2023. So then duration should be less than 3.5 years. Here you get 6.1 because this is in semi-annual period. So you have to divide this by 2 to get the correct answer. Then the Macaulay duration, get it as 6.112 in semi-annual period. So I just kept it as it is, and to get the modified duration, I divide it by the yield, and then I divide it by 2. The answer is 2.91. This is the price. If you have done the calculation, you should get the price of 992,743. Have you got this answer? So remember, when the moment that you see this figure, you should realize this, that something you need some adjustment, because 6.1 is more than maturity. That cannot be. Why? There's a reason here. This duration comes in number of semi-annual periods. We have 7 semi-annual periods, so the duration comes in very close to 6 something semi-annual periods. Then to make it years, you have to divide it by 2. With if you just divide this by 2, you get 3.05, almost 3 years Macaulay duration. If you divide that by 1 plus yield, and you get this. Either way, you can do that.
We can straightly divide it during the calculation of modified duration, or else we can divide in Macaulay.
Because the final answer, or the final answer should be modified duration. That's the answer that you have to give. You can get this 6.12 as it is and do the adjustment here, or you can do the adjustment here and then divide by the 1 plus yield. Okay, anything else?
They're asking interpretation, so you have to explain about modified
How do you interpret modified duration? Can someone give the answer? How do you interpret modified duration? Meantime, tell me if you have to do the calculation or the pricing of the bond using the annuity equation, what is the equation? Now, two questions. One is, how do you interpret this 2.91 modified duration? The second question is, if you have to use the annuity equation, annuity method to price the bond, what is the?
So 1% change in the yield, what is the effect of the price? That will be the modified duration.
You have to be more specific. Outside what is the second? First part is correct. For a 1% change in yield.
Effect of the values actually. Price effect of the value.
What do you mean by effect? Effect, I can say price increase or price
increase or decrease of 1%. The price will change by 2.914. 1%, 100 basis point.
For a 1% change. Yes, for a 1% change in yield, price of the bond will change by 2.91%.
Yeah, percentage. Sir.
That's the proper. You just say price will change by 2.91. That means it's a absolute. It's not. It's a percentage change. Okay. Now the second question. What's the annuity? So how do you use that annuity equation to price a bond? To calculate the price of the bond.
So you need the equation.
Yes.
That
I
is
don't
cash
want
flow.
really. I don't want really.
Sir, cash flow. No, sir. I'm asking the meaning or the equation.
Yeah. Either. No, both.
Yeah, cash.
How do you use that method? That's what you should know.
Cash flow. Open the bracket. 1 minus 1 divided by 1 plus r to the power n. Whole part divided by r.
Sorry?
The whole thing divided by r, sir.
Which whole thing?
No, not the cash flow, sir. The inside part only.
Now, do you have to close that bracket?
Yes, sir.
Divide by r. This is the equation. But remember, r. What is the r? What is n?
So you have to plus the capital also.
Yeah, I'll come to that. First, let me know what is r, what is n.
That is the yield and the number of compounding period.
Yeah, but remember, this is yield again for a coupon period. If it is semi-annual coupon, yield to maturity divided by 2. If it's annual coupon, just the yield. If it is quarterly, it is the yield divided by 4. Then n is the number of
Periods compound.
payments, or the, you can say, number of coupon periods. Not just the maturity Yes. Remember. Okay. As you correctly mentioned, this gives you only the present value of the coupons. But you have to add, when you calculate the price of the bond, you have to add the present value of the face value as well. You get the face value at the end, last cash flow. So discount it by 1 plus RN, again the same R, same. This is in a way the quick method to calculate the bond price. But before you start or decide to use this method or the other basic approach, read through the question and see whether whether you have to do the duration calculation like that. If you have to do the duration calculation, still you can get the price quickly using this method, but however you have to do the same calculation again to calculate the duration. Okay, shall we move forward? We spent 1 hour on that question. Anything else on that bond calculation? Anything else?
So if the question is not specifically giving, is it that's going to be a semi-annual or the annual? Are there any changes there?
No, that depends. Say if it is not a very common bond, it will specifically say whether it's a semi-annual or annual coupon or any other coupon frequency. But say generic things like Sri Lankan government bond, then no need to say it's a semi-annual. That would be the way approach.
Okay, sir.
Shall we discuss the question number 3?
Question number 3. So it's about forward trades. Identify whether there is any arbitrage opportunity available in the market. How do you identify whether there is any arbitrage opportunity in the forward market?
You have to check with the implied rate, sir.
Sorry?
You have to calculate the implied rate and you have to check with the forward rate.
You have to check with the?
Compare with the forward rate and the implied rate.
Yes. So what is the implied rate? What are the information given? Dollar rupee spot rate, USD LKR 3-month forward. What is that? Is it the implied rate or the?
Those are interest rates. You have to calculate.
No, USD LKR 3-month forward 183.1899. What is that rate?
That is the market rate.
That's the market forward rate. Then you have to calculate what is the implied rate. Implied through what? Implied through given the spot rate and the two interest rates. How do you calculate the implied rate or the theoretical forward rate? How do you calculate? How do you calculate the forward rate?
So that is spot rate into the base currency interest rate divided by the counter currency interest rates to the that you have calculated for the number of months.
Forward rate equals spot into
1 plus counter currency interest rate into number of days divided by basis.
this part divided by income. This is
Again, that section should be divided by 1 plus.
the whole thing divided by 1 plus currency interest rate. Sorry, not the foreign currency. Base currency interest rate. Indeed, when we say the account basis, just like what's the annual or number of days per year, that what is that basis? So this is the equation. So all information are given. But you have to just substitute 180 into 1 plus 1.5% divided by 100. Remember, that's another important thing. The way that you remember the equation, it may contain this 100 or not. So in this, there's no 100. Then we make sure that you substitute the interest rate or whatever figures properly. Either you make it decimal and write it here, or write the full figure but divide it by 100. Then the 3 months. So 3 months forward based on 360 day count basis. Then for 3 months, how many days? 90 days divided by 360. Everything divided by 1 plus what is the dollar interest rate? Oh, sorry. This is 7.5. This is 1. So in your answer script, I want to see only these. That's it.
So excuse me, if we are supposed to calculate forward points, this equation should behind this equation we have to put -1, no?
Not -1.
Is it +1?
Okay. How do you get what is forward point? Forward points or soft points? How do you calculate?
Forward rate minus spot rate.
Forward rate minus spot rate. So if you do it here, I would say forward rate, if I change it to forward points, how do you get it? This is the forward rate that you have to subtract.
Minus 1. Subtract spot rate.
Spot rate. Or you can subtract minus 1. That you have to put a bracket.
Okay, sir. Thank you.
Okay. So get the answer and see whether there's any arbitrage. What's the answer?
So if the days conventions are not given, can you use 365 for AKR?
Yes.
If it is not given for USD, we'll have to use 360 and LKR 365, no?
Yes. What is the answer?
Sir, for Euro we are using 364, is it? Okay.
For Euro 360.
360.
Is there any arbitrage? Yes or no? What's the answer? Forward rate.
So 188.61.
180.
188.61.
188. Is it correct? Others, have you got the same answer? What I feel, you are not ready for the exam. You should not take this much of time to do this. The equation is now, I have explained numbers, everything, just to put it into the calculator and get. It takes so many time. I don't know how are you going to do that. The exam.
So 182.68.
182 point.
6899.
899. Yes, that's the correct answer. So now, is there any arbitrage? The
Yes,
question
market
says
is high.
identify whether there is any arbitrage of the market rate is higher than the implied rate. So what the answer what you should write here.
Yes.
You calculate this, get this figure. Yes, because market forward rate is higher than this implied rate. That's enough. In this question, it's not asking you to explain how do you explore that arbitrage and what are the trades that you have to do to make that profit. It's not there. So therefore, you need not to go to explain those things. Just answer the question. So that's my advice, because I have seen that students are writing unnecessary things. It's not asking in the question, but you write a lot of things, then you waste your time. Take your time, think about the question and ask or answer the question, not what you have prepared for or what you know. Answer the question. Then you can save time. But I think in the second part, no, it's not asking if you want to explore this arbitrage, what to do. Okay, if I ask now, so the market rate is higher than the implied rate. If you want to explore that, what do you do?
So you buy from the market.
Sorry?
Buy from the market for 180 and you can sell at 182 for 3 months forward.
You buy from the market
At 180.
180, then
So you can no, it's the other way around. It should be 183. No? So you can buy for 3 months for 182 and sell at 183 to the market.
from where are you going to buy at 182? Market is quoting 183, 189. How do you explore this opportunity? There is an arbitrage opportunity. You have to explore that. What do you do? There are 43 participants in this class today. I can hear only few voices and I don't know what others are doing. You just wait, and just listening, it won't help you. You have, from beginning, I have told you that you have to do these things. You have to do the calculation. I don't see that you are doing it. Okay, how do you explore this arbitrage opportunity? You have only 1 week to. Do you want me to do the second part as well in this question?
Yes, sir.
What is your quote? What you have to quote is yen rupee exchange rate. That's the quote that you have to make for your customer. In the market, you observe dollar yen rate and the dollar rupee rate. Then how do you quote yen rupee rate? What's the answer? Can you all understand the question? First, let me know that one.
So that is 1.6643.
1
6643.
1.6643, correct? How do you get that?
So base rate has to come down. The counter currency, the rate has to come up. That when JPY LKR.
So basically, what do you mean? You divide
Cross division.
cross division. Yes, he did that. Here there's no cross division because you haven't given any bid and ask spread to things.
Yes,
But you have
anyway, it has to divide.
It's a division. It's a division, but which one by which? That's the only question here. So here what we do, dollar rupee rate divided by the dollar yen rate. So then you get the answer 1.664443. No, that's correct. Did others get that answer, or is there anything? So as I mentioned, have you understood the question? Instead of having this long story, I could have asked the question like this as well. Same thing. There's a story, but the underlying message is this. But what you are asking to calculate the yen LKR exchange rate when the dollar rupee and the dollar yen exchange rate given. So I think this can be done by a grade 6 student. This is not a very sophisticated calculation or any rocket science. Nothing, just simple understand. What is the exchange rate? If you know what is the exchange rate, you can do this calculation. The exchange rate given USD LKR 180, then USD JP 108.15. But you have to calculate JPY. What's the big thing here? What does it mean? USD LKR 180. 1 USD equals 180 LKR. Then 1 USD equal 108.15. Yeah. Then what you have to calculate? 1 JPY. How many? How do you calculate? $1 equals 180 LKR, $1 equals 108 JPY. What does it mean?
180 LKR equals to JPY 108.15.
JPY equals to 108 LKR. Then 1 JPY equals 180 divided by 108.50 LKR. 1.6645. Something like this. Okay. Simple as it is. Oh, you can remember those rules. These, whether these are direct quotes or indirect quotes.
So direct quote.
Direct quotes. when you are given two direct quotes, how do you calculate the cross rate? Then the weak currency rate divided by the strong currency. Or on the other hand, the pair that you have to calculate JPY and KR. In this pair, what is the base currency? This is base. This is count. In this pair, counter currency rate divided by the base currency. Counter currency rate divided by the base currency. If it was two indirect quotes,
You have to multiply.
two indirect quotes you have to multiply.
The base has to come up, sir. Base divided by the counter currency.
Then the base divided by the counter currency. When you have two indirect quotes also, you have what you have to do. It's a division. It's not a multiplication. You get the you have the or you can multiply when you have one indirect and one direct. And my advice is not to go by anything like that. Just follow this. You need not to worry about whether this is a direct quote or indirect quote. If you got that one incorrect, the definition of direct quote and indirect quote, again, your answer may not be correct. So my advice is just follow this simple.
But since they are asking for JP by 2 million, do we want to multiply by 2 million and we have to...
What is your quote?
Only giving the exchange rate is enough, no?
Exchange rate is enough, yes. That's why I mentioned. So this is the question. That's it. Then the next question, you may have to use this 2 million. On your code, manager of trade division inform you that he sold JPY 2 million to the customer on spot basis. You decided to immediately cover the position in the market as you are already reached your open position limit. What trades will you carry out in the market to close your position arising due to the above trade? What do you do? What is your position once you enter into this transaction?
I'm short in JPY.
You're short in JPY. How much?
2 million.
2 million. So then what you have to do to cover that position?
Purchase from market.
You go to the market and buy
JPY 2 million.
JPY 2 million. But thing is that's perfect. But in the Sri Lankan market, you may not be able to go to another bank, Sri Lankan bank, and do a yen LKR trade. What you have to do, ultimately you have to buy JPY. Practically what would happen, you do a dollar yen transaction in the international market with one of your international counterparts. Maybe a bank in Singapore, Hong Kong, or Japan, or maybe London, depending on the time. That's what you have to do. So basically what you do, first you execute a dollar rupee trade in the market where you buy dollars against rupees. Then use that dollars to buy yen in the international market. So therefore, the best answer would be here: buy dollar from the local market, local interbank market, and sell a dollar yen transaction. That means sell dollars and buy yen in the international market. That would be the perfect answer. But in short, yes, what you have to do: buy 2 million yen. The part 4, what are the limits that you have to consider before you execute the above mentioned transactions in the market? What are the limits that you have to consider? What sort of limits are there?
The counterpart.
In
Sorry,
Counterpart limit you want to say?
counterparty limit.
in this question, Ms. Nishanta, we don't need to necessarily limit our scope to within exchange rates only, no? Generally, it's asking about the limits, no?
Yes. What are the limits applicable?
Dealer limit.
Dealer limit and the counterparty limit. Is there any
NOB position.
NOP position you can mention? But yes, even the previous one, it's say that you have reached NOP. You are going to do the trade to cover that. So you can mention yes, but basically now you are going to do a trade to cover your position, bring it to the within NOP limit, basically apply counterparty limit and the dealer limit.
So for the earlier question, that just buying yen is enough, writing that enough? You have to explain.
No, better. In this letter, you explain that you buy dollars in the local market, interbank market, and sell that dollars in the international market to buy yen. You have to execute 2 trades. That's why 6 marks given.
So you have to mention the local market, international market.
Yes, yes.
So for the fourth question, can you mention value at risk as a limit? No.
Value at risk. You mean for this question?
It's for the fourth one.
No. It won't get affected because you are squaring your position. Then you will be at the same place where you were. So your value at risk won't change. By the way, did we discuss value at risk?
No, sir, we didn't.
No,
No.
I think it's not covered, no?
Yes, that's what I remember. Okay, shall we move forward? Or anything else?
Yes, next question 4.
There are 4 parts. Which one? First part is about forwards, 3-month forward price. what is the difference between this forward and the forward that we did, FX forward? In the FX forwards, we have two interest rates.
So the presentation is not available.
Which presentation?
You are displaying.
The slide.
Sorry, I didn't get that.
That slide is not available.
Which slide? I'm not showing any slide.
Okay.
You can see the paper, no?
Yeah, yes.
Yeah. Okay. So now I mean here we discussed the forward exchange rates. Yes, forward exchange rate. To calculate that, we need two interest rates. But in the fourth question, it is a forward on crude oil or whatever the commodity. In other forwards other than forward exchange rates, we just need only one interest rate. That's what I wanted to highlight. That's the key difference between foreign exchange forwards and the other forwards. What is the model that we use to price a forward?
The cost of carry.
Cost of carry model. So how do you do this calculation? Calculate the 3-month forward price for a barrel of crude oil. If the current spot price is 62 per barrel, 3-month interest rate is 0.75% per annum, and 3-month storage cost is in a floating tanker are 1.5 dollars per barrel. So then what is 3-month forward rate? Sorry?
63.6162. Correct me.
Interest rate is 0.75%.
This was answer. 61625.
63.61625. Yes, that's the answer. How do you get that?
Get the 3 months interest component out and add the barrel tanker cost.
Basically, what is your cost of keeping 1 barrel of oil for a 3-month period? You have to spend incur a cost of $62 today to buy a 1 barrel of oil, and when you keep it for 3 months, you incur the interest cost. So therefore, we have to calculate the interest expense on that. On top of that, you have to pay the storage cost of $1.5 per barrel. Add that one as well. So forward price is 62. That's the cost. Then what is the interest? 0.75%. But this is annualized per annum. but we need it only for 3 months. So simple interest calculation, 0.75% for 3 months, 90 days divided by 360 plus 1.5. This is the storage cost. What is this? This is the interest expense. This is the, you can say, spot price. The cost of a oil barrel. You get 63.61 per. So 6162. So you can see the calculations are not difficult. Only thing you should know how to, which equation or which model is to use. Again, there's a arbitrage question. Assume that the above future is trading at 64 barrel in the $64 per barrel in the market. Identify whether there is any arbitrage opportunity. Is there any arbitrage opportunity?
Yes.
Yes. Your implied cost of the forward is only 63.61625, whereas in the market it is trading at 64. Again, what you have to say, you know, it's now in this question it's given there's an arbitrage opportunity. So what are the transactions that you carry out to make the arbitrage profit?
Buy the underlying asset now and sell a future.
Buy the underlying asset now and sell
Sell a
a future. Is that all?
The cash
Buy
and debt. That is, you have to borrow money. Buy
You have to borrow dollars first. Yes. You borrow dollars at what rate?
At the spot
You have
rate.
to- You borrow dollars at
Once.
Point 7.
at 0.75.
0.75.
For how long?
3 months.
For a 3 months period. That you have to mention. You have to write borrow dollars at 0.75% for a 3 months period. Then what do? You use that borrowed amount to buy oil at 62 per barrel. You use that borrowed amount of dollars to buy oil at 62. Then you keep it for a 3 month period, paying the storage cost, and you enter into a futures transaction or a forward transaction to sell oil in 3 months time. Then after 3 months time, on borrowing you have to pay 62 plus this amount and another 1.5 for the tanker as the storage cost, but you will receive $64 per barrel. The difference is your profit. That part it is not asking, it's asked for write down the transaction that you carry out to make the arbitrage profit. But you have to say sell a futures contract, borrow dollars, sell a 3 month futures contract on oil, borrow dollars at 0.75 for 3 months period. Use that borrowed dollars to buy oil and keep it that oil for 3 months. That's what we have to say. Then the
So there we have to calculate and show it or no?
no, it's not asking. Even there's nothing to calculate, just the profit. That's the difference between what you calculated here and the market futures price.
I mean, how do we, how much we going to get as a profit now?
This how much? What's the profit if you have done that transaction?
64 minus this.
64 minus 63.6162. That means 0.38 something. 38375. In the third part, it's about options. What you have to do, draw the profit diagram for a buyer of this option at the expired. What is the diagram? This is a put option. What is a put option?
Right to sell.
Buyer gets a right to sell. So then buyer exercise the right when does the buyer exercise his right?
This,
When the spot price is below the strike price.
When the spot price is below the strike price. Then the profit, what is the profit?
spot price minus strike price.
Spot price minus strike price. You exercise the option when the spot price is below the strike price. So when you calculate the spot price minus strike, it will be a negative.
So that should be a strike minus spot minus premium.
Strike minus spot. Remember, that's not the profit. Strike minus spot, you get the payoff for the put option. But to calculate the profit, you have to deduct the premium that you paid to buy the option. To buy an option, you have to pay a premium. So you have to deduct it from the payoff to calculate the profit. What is the shape of the profit diagram? What are the two axes? This is a long put. What are the two axes?
The profit and the spot price.
Profit and the spot price. Which axis shows the profit?
The horizontal line.
Profit.
Profit is the other vertical one.
Is the profit. What is this?
Spot price.
Then what is the strike? 180. So this is the strike. Then if I first draw the payoff, what is the shape of the payoff back? If the spot price is above the spot price is above the strike, what is the payoff for the put option buy? If you are a
So
put
it's
option buy,
come along with the line and go up.
you don't get anything, or you don't exercise your right when the spot price is higher than the strike as a put option buyer. So therefore, no payoff, zero. So therefore, this part will be on the exact zero. This is zero. So no payoff. But what could happen when the spot goes below strike? You will exercise your right, whatever the difference between the strike and spot, you will get. So therefore, your payoff will increase when the price moves down. This is the payoff. But what is the profit? It is the payoff minus the premium. So therefore, up to this point, you will incur a loss which is equal to the premium then it will start to go up. So two parallel lines. This is the maximum profit that you can earn. What is this point?
Break even.
Break even point. What's the break even price?
Strike minus premium.
Strike minus premium. So therefore, it is 180. Premium is 2. So this is 180. What is this? What is the maximum profit that you can earn? And when do you make the maximum profit as a put option buyer? When the spot rate goes to 0. When the spot rate goes to 0, you get the whole difference. That means 182 as the payoff, but we have already paid 2 rupees premium. So therefore, this is 180. So this is the diagram. I don't expect you to draw this blue line, but the red line, not only the red line, just the shape. You have to identify these points as well, and the two axis. And what is this? So this is indeed minus 2. This is minus 2. This is 180. This is also 180. This is 182. Those things should be labeled properly on the graph. What is the shape of the call option? What is the shape of a profit diagram of a call option?
It has to come other way around.
What do you mean other way around?
That premium of 2 parallel has to come with the spot of it.
Sorry? So basically, if the spot rate is below the strike rate, do you exercise? Do you get anything? No. In a call option, you exercise your right only when the spot price is higher than the strike. So below the strike, you don't exercise. So you lose your premium. Then thereafter, you exercise your right, your profit will go up. Again, this is break even. This is equal to premium plus strike. Any question? Part 4. Rupees 80 call option on a stock trading at rupees 83 is priced at 6 rupees. What is the time value of the option? What is the time value of the option?
So that is 3.
That is 3. How do you calculate? What is the relationship? If you can remember, in an option value for the price, we have of option value. You have 2 components. What are those?
Intrinsic value and the time value.
Intrinsic value and the time. What is intrinsic value?
Yes. That is depend on the type of the option.
Yes, depends on the type of the option. However, what does it mean? Whether you make something. So in this case, if the spot price is less than the strike, what is your payoff? The difference between strike and the spot. In a call option, it is other way around. You make a profit if the spot price is higher than the strike. So the intrinsic value would be spot minus strike. But what is time value? Now we are talking about before the expiry. There's a time period from today to the expiry. Within that period, spot price may change. So many things can happen. Volatility may change. Interest rates may change. So therefore, value of the option may change in the future. For that uncertainty, what do we add? That is the time. So the option value of the option is the sum of these two, intrinsic value and the time. So now what in this question you are given spot price is given, strike price is given, and the value of the option is given. Value of the option is 6. Then you are asked to calculate the time value. To calculate the time value, you need the intrinsic value as well. If you know the intrinsic value, the difference between value and for the premium and the intrinsic value is the time value. How do you get this intrinsic value? In this, spot price is given as 83 and the strike is given as 80, and this is a call option. So what is the intrinsic value? It is the spot minus strike when it is positive, only when it is positive. So 83 minus 80. Intrinsic value is 3 rupees. 3 times 3 plus time value equals 6. Then time value equals 3. Then can you remember we discussed about in the money, out of the money, or at the money. What does it mean? What does it mean by in the money option? What is meant by out of the money option and in the money at the money option? In the money, out of the money, at the money. Can you remember?
In the money means there is an intrinsic value for positive.
When there's a positive intrinsic value, we call it a in the money option. So for a call option, the option is in the money when the spot price is higher than the strike price. But for a put option, it's other way around. There's a intrinsic value when the spot price falls below the strike price. Out of the money, that means you don't have intrinsic value. We don't say negative, but if you calculate the strike minus spot or the spot minus strike, depending on the whether it's a call option or a put option, if that comes as a negative figure, that means intrinsic value is 0. The option is out of the. At the money means when do you get at the money option? What is the condition?
Strike
When
and
the-
spot should be same, sir.
Yeah, when the strike equals to the spot, then it's the at the money option.
So in question number 2 also, there is a question related to spot rate.
Question number 2.
Yeah, 2, Roman numbers 2.
That's what I mentioned. You can't do that. This spot rate is not the exchange rate. This is a spot interest rate. We didn't discuss this, so you cannot answer that.
So if that won't come for an exam,
Yes.
that won't come. That spot rate curve one, no sir.
Sorry?
That spot rate curve question, that one, no, you tell. Treasury spot rate curve, that.
No, it won't come.
Thanks, sir.
Because we didn't discuss that. So then what else?
Question number 5.
Question number 5. This is about, I think, ALM part. Yes, a zero coupon rate. You are given few assets and liabilities. Three assets and 2 liabilities, and asking you to put these into the correct buckets. The bucket in structure is given. Assume you are required to prepare please place the correct amounts into appropriate time bucket correspond to each and every asset and liability given above. Okay, zero coupon bond. Where do you put in these? It's a zero coupon bond with a face value of 1 million, maturing on 1/1/2021. Now you are in 1st of December.
0 to 1 months.
0 to
Sorry. 0 coupon bond with a face value.
Yeah. Two things you have to decide for each and every item: amount and the bucket.
Yeah, 1 to 2 years.
1 to
2 years.
2 years. Why?
A 0 coupon bond with face value maturing on 1st of January 2021.
Mm-hmm.
You are doing it on 1st of December 2019.
Mm-hmm.
So more than 1 year, no? Little more than 1 year.
More than 1 year, but less than 2 years. So you put it into this bucket. What is the amount?
Your screen we cannot see, Mr. Shah.
The paper?
Yeah. Is everyone having that problem?
Yeah, we also can't see.
Can't you see the paper?
Try representing. No, you try representing.
Okay. Now what you can do? See.
Now nothing.
Nothing. Now?
It's trying to present. Okay. Now okay.
Okay, sorry. So here the 0 coupon bond, it's into the 1 to 2 year bucket. What's the amount?
1 million.
1 million, the face value. Then select, get the next one. $500,000 loan granted on July 15, 2019 for a 5-year period at a floating rate. The rate is fixed in every 6 months. Where do you put this one? What is the time bucket? Corresponding time bucket.
Three months to 6 months, 1 year, no?
3 months to 6 months. Why?
Sorry, 1 year.
1 year. 3 months to 1 year. Why?
It's a floating and scheduled 6 months.
It's a floating. It's a floating rate. It's it will be repriced every 6 months. But when was it issued or granted? July. Then what is the next repricing date?
2019 October.
October. Why? 2019 October.
Because that
So January.
sorry, January
2020.
January 2020. Now you are on 1st of December. Then can you put this into the 3 months to 1 year bucket?
No, 1 month to 3 months.
It should be more than 1 month. but it should be in the 1 to 3 months bucket. So you are in 1st of January, it will be repriced on 15th January. So it's about 1.5 months time. Therefore, you have to place it in the 1 to 3 months bucket. Yes, it's the bucket given 1 to 3 months. Should be 1 to 3 months bucket. What's the amount?
500,000.
500,000. Then the third one is amortized loan. In amortized loan, where do you put? And
Mr. Nishant, 500,000 rupees, 500,000 loan granted on 15 for 5-year period. So that is a capital amount, no?
yes,
Capital amount for 500, the rate is fixed in every 6 months. So putting 500,000, the capital amount will be received only after 5 years, no?
now we are not talking about the capital amount that we are going to receive. We are going to discuss the interest rate sensitivity.
Okay.
So the interest rate.
So the first one, 0 coupon bond, will be coming under the more than 2 years bucket, no?
Yes,
Okay.
that's what we put. No?
Thank you.
1 to 2 years.
No, wait. 0 coupon bond 2016, 2021. Now we are in 2019.
13 months more.
13 months. Then it should fall into 1 year to 2 years. Not more than 2 years.
1 to 2 years, no?
1 to 2 years, correct?
Thank you. Thank you.
2021. Okay, then amortized loan.
Amount also same, not 1 million.
Amount is 1 million, yes. In the amortized loan,
Will it fall into 3 buckets?
why?
Payment, there are whatever the payment dates that is falling within our buckets, we'll have to consider that, no?
Payment dates, yes.
There is annual repayments, no?
Yes, annual repayments. According to
So-
the schedule is given, there are annual repayments. Then you
So
have to
based on
consider that. Yes.
each payment date, if it falls within a bucket, we'll have to consider that, no?
Yes.
So it comes from 3 months above, all 3 buckets it comes.
First 2 buckets are already gone.
Yeah.
First 2 payments already done. So we don't have to worry about those. Then what we have to think about next 3 payments. The next one is in August 2020. So it's more than 3 years. Sorry, more than 3 months, but less than 1 year. So the one cash flow will fall into this bucket. Then the second, third will go into the remaining 2 buckets, correct?
Yeah.
And what are the amounts?
In this instance, since we have the interest amount separately, we can only put the interest amount.
What do you put in the bucket?
The total payment, no?
Since it's interest rate sensitive, should we consider only the interest?
Now, interest is what you receive. What is sensitive to the what is the rule? We place only the principal amounts in the bucket. We don't consider the interest in the amortized loan. So we just put 198, 218, 239 into these three buckets.
The last three buckets, no?
Last three buckets, yes. Then the liabilities, 6-month certificate of deposit issued 2019 July. Okay, when it is maturing then? Liabilities. There are two liabilities. Where do you put them? It is issued in July for a 6 month. That means it will mature in January. Again, it will fall into 1 to 3 months because more than remaining maturity is more than 1 month, but less than 3 months. So it will fall into the second bucket. Overnight borrowing, another liability. It's overnight borrowing. Where do you put that one?
0 to 1 month.
0 to 1 month. It's just 1 day, so it will be in the 0 to 1 month bucket. If you look at this interest rate gap report, what are the risks? If you see this gap report, what is your risk?
Long-term interest rates going up.
Long term.
So short-term. 0 to 12 months.
Less than 1 year.
Yeah, less than 1 year going up.
If the interest rate goes up near future, so your liabilities, you have to generate new liabilities at a higher rate. So that's the risk.
In the sense, we can give. No, okay. Only one part of it, no. Short-term interest rate going up only.
Yes. Not necessarily to be the short run. If the interest rate goes up, indeed, short run interest rate goes up, then all these liabilities, you have to reprice it at a higher rate. So you have to borrow at a higher rate. Is it the only risk? Is it the only risk?
We have assets also in our book.
Assets are there, yes.
So can we consider counterpart risks also here?
No. Yes, the counterparty risk is there, but in this context, you don't have to think about it. But looking at this gap report, what you can see.
Settlement risk.
No. When you have a negative gap.
The funding risk also there, sir.
Funded risk, yes. You may not be able to generate required funds because you are short. You have to borrow. You have to cover that short position. So that funding risk is there. So if your parties or the counterparties is not willing to lend you, then you will be in trouble. You face the liquidity risk. So if interest rate goes up, your interest margin either reduce or maybe negative. That's one thing, the pricing risk. On the other hand, you face the liquidity risk. You may not be able to generate required funds. So in this question, we have to mention both. What can you infer about expectation of BRC bank on interest rate? What you can. Oh,
So there is no funding risk there, no?
there's
There are
no.
only, yes, then since we have liabilities more than the assets,
I didn't get that proper.
do we have funding risk there?
Yes, why not? When you
Yes,
have
we have assets, liabilities more than assets.
yes, when you have more than liabilities than assets in the 0 to 3 months, when liabilities are maturing, what are you going to do?
You need to settle.
You have to pay that. How do you settle? It's very simple. You get your salary somewhere in say 25th at the end of the month. If you have to make a payment in 10th of that month, how do you do that? Something like that. So even on the salary date, if you have a payment more than that salary, what do you do?
Sir, in this case, the liabilities are our deposits, no? So we have enough deposits.
So if you have enough deposits, to do what? You have enough deposits.
So we can grant loan.
What do you mean by enough?
No, more than our assets we have.
More than assets, you have liabilities. What does it mean by liability?
How to pay back one day.
You have to pay back. So
Yes.
within 3 months, you have more liabilities than assets. As I mentioned, say by December 25th, 24th or 23rd, you are supposed to receive your salary, that is your asset, but you have to make a payment on the same day, but more than the salary. Then you have more liabilities than your assets. Can you meet your liability?
Okay, sir. Okay. So maturing, that's okay.
Okay, what is the interest rate expectation of this bank? Basically asking, when do you maintain this sort of balance sheet?
Short-term interest rates are going down.
Yes, that's their expectation. They think interest rates in near future will go down. Then they can raise new funds at a lower rate while maintaining the assets at the higher rates, increasing the net interest income. So to answer that question, you don't have to say that. Just you can say short-term interest rate or the interest rates to go down in the near future. That's what they expect.
Nishant, now these assets and liabilities, if we have already booked, if the interest rates are agreed, with based on fixed or floating, also our answer will have to change.
No, no, because based on that only we put it into this bucket.
Yeah. So if the interest rates are already, if we know the interest rates, even if the short-term or long-term interest rates change, it will not have an effect to us. No.
Why not? Say now you haven't got the concept at all. Why did you put that floating rate loan into this 1 to 3 No, less than one.
Repricing.
No, sorry, 1 to 3 months.
Since the repricing is 6 months.
Repricing in 6 months, but compared to our date, it is falling just within 1.5 months.
Yeah.
Then the floating rate, you have to reprice it at that date. Okay,
Yes.
why do you put that overnight borrow? Okay, 6 month deposit into again same 1 to 3 month bucket?
Because that is also, I mean, the 6 months in period is falling on that.
So that liability will mature
Yeah.
within 1 to 3 months. Then what do?
Settle that.
You settle it. How do you settle it?
From whatever that you.
That
from
depends.
what-
But it depends whether in that bucket you have more assets than liabilities. There should be a asset maturing or assets maturing more than that liability amount. Otherwise, you have to
Borrow.
raise new funds.
Yeah, for raising new.
At what rate you raise new funds?
At that present rate.
At whatever the rate prevail at that time. So therefore, that's why when we have these negative balances, what does it mean? Within 0 to 3 months, we have to generate 100. Then next
Especially
year,
we have to generate
50. Within the last 6 months, 200. So we have to raise new funds. So that is sensitive to interest rate. Whether these assets are at a fixed rate or whether these liabilities are at a fixed rate, it's irrelevant. Based on that only, we have put all those things into this bucket. Then the net amount, what matters? If the net amount is negative, that means you have to generate new funds
for settlement.
in this, yes, for settlement or to fund or maintain your assets. Otherwise, you won't be able to maintain your assets. When you raise these funds, it is at the new rate. Say this is positive, then what does it mean?
Still, if we then we have to consider the reinvestment.
Reinvestment. Then again at the new rate. So this amount is at risk in that sense. Either to borrow or reinvest. So you face the interest rate risk. Clear?
Yeah, yeah.
Anything else on this paper?
So that Roman number 3.
There's another point. Assume duration of assets is 4 and duration of liabilities is 3. The bank's capital to asset ratio is 5%. Calculate the duration of the bank's equity. How do you do that? Can someone remember the equation? Can someone tell me how to do this?
So capital plus liability is equal to the assets.
Plus liability is equal to the
Asset total.
So I didn't hear the last one.
Say asset total.
Asset. Basically, your fundamental equation of assets equals liabilities plus equity means capital. Correct?
Yes, sir.
Okay, that's what you mentioned. Fine. Then what is this 5%? What is this 5%?
So that is capital to asset ratio, no? So 5%.
Capital to asset ratio. What does it mean?
If the capital is 100, 5%, 5 is the asset.
Hmm?
So if we are taking capital as 100, the 5 going to be the asset. Then we can apply to the equation and say that.
Can it be capital is bigger than asset?
No, sir, no.
Isn't it? Isn't it that 5%? When you have 100 asset, 5% is only capital. Now, what is the question? What is the duration of equity or the capital? Bank's equity. How do you calculate it? Duration of assets is given point. Duration of liabilities by rearrange this, equity value equals asset minus liabilities. If the value of asset changes, value of liabilities changes, value of equity changes. Duration gives us the percentage change in asset and percentage change in liabilities. Then we get the percentage change in equity. But as a percentage. So therefore, what is duration of assets? This is the change in percentage change in assets. Duration of liabilities is the percentage change in liabilities. But you have to find duration of equity, that is N. If you know this, what is N? I can write here E equals delta E equals change in assets equal change in asset, or change in equity equals change in assets minus change in liabilities. Whatever the change, the difference is reflected in the equity. So these, can we get what is change in assets? A into asset duration. Change in liabilities, A into liability duration. Can we substitute these two? This is asset, this is liabilities. We can substitute these two parts into this equation. L into A. Duration of liabilities. Correct? It's the change in asset. But what we need, not the change, percentage change. Then we can divide this by equity. If I do it, write it here. Change in A divided by E equals A into asset duration minus L into equity duration divided by E. Now, see what are the information given. This is given. This is given. And instead of E over A, we need here A over E. Then what is L over A? Then you find out. What is L over E? What does it mean? How do you interpret this? When we have 100 assets, capital is only 5. Then what is liability? When we have assets of 100,
95.
here capital only 5, then 95. So use this simple thing. What is AOI 100 over 5? What is L over E 95 over 5? Then you get the duration of equity. So, but thing is, this is the background. If you refer your handouts, you would see the equation something like this. You need not to do all those things. You can just use the equation. I went through all these things just to explain what is behind this. So then you get the duration of equity. What does it mean? If interest rate change by 1%, your equity value will change according to that. Same interpretation of duration what we discussed. The same in fixed income securities. The duration what we discussed in fixed income securities, the same interpretation you can use, because duration, the same concept, but apply for assets and liabilities and equities. That's the difference. Okay, anything else?
So in the question number 3,
question number 3,
yeah, in that FX arbitrage, I think we can use the covered interest arbitrage, no, sir?
in this, it's asking whether there's any arbitrage opportunity.
Yeah,
that's why we
available. But if we are more detailing, the arbitrage which can use is the covered interest arbitrage, no, sir?
Yes, covered interest rate parity. That's why forward is calculated based on that covered interest parity.
So can you slightly explain how to explore that?
This one, if there's any arbitrage, how to explore?
Yeah,
no,
yes,
I'm not,
sir, please.
No, I'm not going to do that. You should be able to do.
No, I have to go through the handout then.
That's I see. I saw that none of you, I don't know, based on your discussion, you are not ready. So how many of you now have a formula sheet with you? Do you have a piece of paper just listing the formulas that you, what is the present value equation, what is the annuity equation, what is the relationship between yield and discount rate, how to calculate the discount, then even this one, forward, how to calculate the forward exchange rate, what is the cost of carry model, things like that. Do you have any?
So yeah, I have the equations with you, not other parts.
But likewise, you now by now you have only one week. You should prepare for that with now. I don't know why. In my view, you wasted your time today, this morning. You wanted me to do each and every part. Why can't you answer these simple questions? Even though this say your laziness, it was reflected. Even you wanted me to do this part, this simple exchange rate. If you are not ready to do that now, I don't know what I'm going to do in next week. And what I feel, even after I explain, you don't want to key it in the calculator and get the answer. That's what I felt. That's why I prefer if we could have the physical class. Then until you do this, I won't move forward, because for me, what I don't want to do these calculations. From the beginning, I have mentioned you have to do. Then only you come up with difficulties, problems, things like that. Say in the duration calculation, it's not that's something that you should have asked. So we did the calculation. I get the duration of 6.11, but the remaining maturity is only 3.5 years. Then how can I get this 6.1? Something wrong. What is that? That sort of question should you should bring to me, not just say, "Sir, we'll do this calculation." I can do. You will see it. Fine. You won't be able to do it. Whenever you do that, only you will come up with problems. Then something wrong. Then you have to identify what is wrong, what went wrong. Those are the things you should have asked. If you have done that within first hour, we could have finished that. Then I could have again brief the key points. Okay, how to do bond pricing, what is the equation, what is the cost of carry model. So say options, different type of options, American options, put options, things like that. We could have done a lot. But what you wanted me to do all these questions, no point. Now too late. I saw some people now only looking for this paper. So it shows your commitment. And I prefer to go through these MCQs. You get to know the concepts. If I ask you, very simple. Say this. Take this question. What is the answer? Can someone tell me the answer?
About 11,000.
About 11,000. Any other answers?
So index price is not given, sir.
So answer D, not sufficient information. Correct? That's what you mean. In index.
Yes, sir. Yeah.
No, but index is given. Stock index is 11,000. It's given. That's what you mean. No? Price of the index is not given. Index value is given.
Yeah, the dividend is higher than the interest cost, no? Below 11.
Below 11.
Yeah.
Yes. So see how tricky this question. You don't want to do any calculation. Nothing. If you have the understanding of the cost of carry model, what you do, take the current cost or the current price, add whatever the cost and deduct whatever the benefits. Now, what are the costs? Interest and storage and things like that. What are the benefits? Dividends or coupons or some other rent income or something like that, whatever the benefits. So if your benefits are higher than the cost, what does it say in the cost of carry model? Futures price would be lower than the spot price.
Spot price.
If you know that basic concept, then only you can answer this question. Otherwise, you will go around and you spend. You will do all these calculations and come up with the figure, and then we'll compare whether it's above 11,000 or below 11,000. You don't want to do this. The concepts.
Mr. Nishant, question number 16.
16.
Yeah.
This is so this one, no?
Yeah.
What equivalent rate would you pay annually if you were prepared to pay 6% semi-annual? Okay, what does it mean?
The semi-annual return is 6%. They are asking the annual return percentage.
If what is the equivalent annual rate? Simply, it's asking what is the
Annual return.
Annual EARO, EAY, whatever you call it. What is that? How do you calculate it? How do you calculate it? If the semi-annual yield is 6%, what is the effective annual yield? So that's the thing. So did you understand? That is the question asked. What is the effective annual yield? Simply. Oh, sorry, it's other way around. What equivalent rate would you pay annually? Yes.
It is there.
Yes. Semi-annual rate is given, asking the annual rate. How do you calculate it? How do you calculate?
R divided.
Basically, this is the frequency. If it is less than 1 frequency, so you divide the given interest rate by that frequency 1 plus, and take the power of the same frequency. Then you get the compounded amount. Okay, minus 1. You get the. So should it be more than 6 or less than 6?
More than 6.
More than 6.
Should be 6. I guess answer may be 6.09. Cannot be a big change. Yes, 6.0. Correct.
Yes, sir.
What's the answer for this question?
D, yield to maturity.
Yield to maturity. Okay, anything else?
Question number 27.
This one. What's the answer?
Yield change. C.
Price value of basis point is a closely related to yield change. What does it mean by a price value of a basis point?
Duration.
No, no. Answer my question. What does it mean by price value of a basis point? What does it mean by a price value of a basis point?
Percentage change of for 1 basis point.
What is the percent? No. Price value of a basis point. That's the question. And the duration. It's asking the price value of the price value of a basis point. So how do you interpret, oh, yes, how do you interpret the price value of a basis point? Or sometimes it's called a DVO1, dollar value of a basis points, both are same. How do you interpret it? If the yield changed by a 1 basis point, what is the change in value? It gives you the absolute figure, not the percentage change. So then, now tell me the answer.
Yield, sir.
Sorry?
Yield.
Yield. No. Yield change is given 1 basis point. That's given. It's fixed in that.
Market price.
It's a duration, right? It measures, it can tell you how much your outcome change once 1 basis point of the yield change.
That's the duration, but there's no answer like that.
Then it's market value.
Market value matters, yes, true, but that's much closer thing. That's the dollar duration. What is dollar duration? What is duration? Duration is the percentage change for a 1% yield change. No? What is dollar duration? Duration into market value is the dollar duration. Then we have already calculated the dollar amount for a 1% change. Then what do we have to do? Divide it by 100 to get it to the price value of a 1 basis point, because 1% is 100 basis points. So the closest thing is the dollar duration. Dollar duration also a dollar amount. Price value of a basis point is also a dollar amount. Only thing is the interest rate change is different. In the dollar duration, it's for a 1% change. In the PVBP, for a 1 basis point. So dollar duration divided by 100, you get the price value. Anything else? Or either on this, in this paper, or any subject area that we discussed?
So can you go now? Question number 1.
Question number?
Question number 1, sir.
Question number 1.
Yeah, and the Roman number 1, 2. Yes. Second one.
The interest rate risk of a bond is normally lower for higher coupon.
Yes.
Yes, whether it's true or false. How do you measure the interest rate risk? How do you measure the interest rate risk?
Duration.
Duration. Okay. Now, what is the relationship between duration and coupon?
Higher the duration, higher the coupon, higher the duration.
Higher the coupon, higher the duration.
Yes.
Any others? Any other answers? Is it correct?
Yes, I agree. Agreed, sir.
Correct. Higher the duration, higher the coupon, higher the duration.
It's the other way. Higher the coupon, lower the duration.
Higher the coupon, lower the duration. Why? When the coupon is high, you get big cash flows frequently.
So you can recover it.
You can recover fast. That's the case. So either you have to remember things, or either you have to get the intuition behind that. So the best thing is to get that intuition. Then you can logically derive the answer. If you try to remember, that's pure luck. If you remember the things properly, yes. Otherwise, it will be a guess. So this is true or false? Is this true or false? The interest rate risk of a bond is normally lower for higher coupon.
True.
Very true, right?
It's true, and you have to explain it as he mentioned. When the coupons are higher, we recover our investment faster. So therefore, the duration is low, something like that. What about this one? Fourth one.
False. Sir, false.
It's false. Why?
Cannot be done by any employee of the bank.
Sorry?
Confirmation of a transaction cannot be done by any employee of the bank.
Then who should do that?
Middle office.
So
Middle.
back office.
It should be done by the back office. Yes.
Sir, can you explain third one?
Positive convexity implies that the price rise at a decreasing rate as yields fall. Is it correct or wrong? True or false? What is positive convexity? That's the key here. What is positive convexity? What is positive convexity? Where did you discuss that?
Duration and convexity.
Yes. So what is positive convexity and what is the impact?
The bond prices and the bond yields are positive. The convexity, if the bond prices and the bond yields are positive, so the
Bond prices and bond yields are positive. Is it correct? What is the relationship between price and yield?
Negative relation.
What does it mean, negative?
Downward slope. It's a curve. No?
It's a curve.
Downward slope.
This is also downward slope. When the yield increases.
The inward curvature.
Is something like this. This is called positive convexity. This is negative convexity, and the linear one is zero convexity. Zero convexity means linear. These two are not linear. This has a positive convexity, this has a negative convexity. So now the question is, or the bonds and yield and price relationship shows a positive convexity. Then what is the impact? What happens when the yield drops? What happens to the price?
Price increase.
Price increase. Still you didn't get. When you have a negative, or the positive convexity, what is the impact? You have this relationship. What happens if yield drops? Still price increase. Even zero convexity, price increase. Even with negative convexity, when yield decreases, price increases. What's the difference in these three?
Rapidly increase.
Yes, when you have a positive convexity, when yield drops, price increase at a higher rate. But when you have a negative convexity, the black color one, when yield drops, price increase, but at a when it comes to the low end, the rate of price increase gets low. That's what happens. So positive convexity implies that the price rise at a decreasing rate as yield falls. Is it correct? When you have positive convexity, price increase at a increasing rate as yield falls. For this change, what is the price change? Only this much. But if we go to this, for the almost same change, you can see a big price increase. The rate of price increase is increasing when yield falls. That is positive convexity. So therefore this one is false. So I have drawn this one many times, and I have told you this is a very important relationship and how to interpret. Anything else?
Ninth one, sir.
Ninth one. The cumulative gap as a percentage of total assets is less than the cumulative gap as a percentage of interest earning assets. Is it true or false? What is the cumulative gap? What is the cumulative gap?
So difference between assets and liabilities.
Is it the cumulative gap? What is the cumulative gap? It's a difference between assets and liabilities, but it's not just difference between assets and liabilities.
So all the time buckets.
Yeah, up to a time, for say for different time buckets we calculate the gap, but then we add them together to a certain point. That is we call the cumulative gap. Say 1 year, then from 0 to 1 year we add all the gaps and we get the net figure. That's the cumulative gap. Okay, to answer this, do you need to know this? What is cumulative gap? No. But what you need is the difference between total asset and the as a percentage of interest earning assets. That's the only thing that you have to know. What is total assets? What is interest earning assets? If you have some idea about that, let me see now. Why? What is the question? Cumulative gap as a percentage of total assets. Correct? Cumulative gap divided by total assets into 100. Then the cumulative gap as a percentage of total assets. The other one, cumulative gap as percentage of interest earning assets into 100. Which one is high?
Interest earning asset cap should be high.
This should be high. Why?
This is it's a part of total asset.
This is only a part of total assets. Then when we compare the total assets and interest earning assets, this relationship holds, or it can be same if all assets earn interest. So when we have this relationship, whenever we take the reciprocal of this, the sign changes. Basically, we divide the same number by a large number here by the small number. Then we get a large number. So that's it. So therefore, the cumulative gap as a percentage of total assets is less than the cumulative gap as a percentage of interest earning asset. That is true because interest earning assets are less than the total assets.
So 10th one also.
Sorry?
10th one. Yes.
Indirect quote in foreign exchange refers to price of foreign currency is quoted in domestic currency. See again. So you have not done anything.
So
Indirect.
So they are in indirect quotes means we are using USD as the counter currency, no?
Hmm.
So when we apply that, when we apply it to the currency, the euro currency, let's say euro and USD rate, it's indirect one. In that, when we apply that to European country, that definition there's
that confusion I explained. So that is there. So even dollar rupee, then how do we say dollar rupee is dollar yen is okay, dollar yen direct, we call it a direct. Again, how do we classify whether dollar is the foreign currency or the yen is the foreign currency? That it is there, but in the market there's a norm for that, what we consider as foreign and what we consider as the local. So by that convention, you have to follow this.
So it's false.
Yes, to remember that properly. Only that I mentioned that whenever the base currency is dollar, it is direct quote. So in that case, okay, then what is foreign currency? Dollar rupee, dollar yen, whatever. When the dollar is the base currency, we call it a direct quote. What is the definition of direct quote? That means, then what is foreign currency?
So, sir, in case of that, as a definition, we can use that USD.
Same can be applied in the indirect quote as well.
That means you should use the USD when comparing the. That's the.
Yes, that's the method that, or the norm in the market. So the definition given here is, it's the direct quote definition. Foreign currency is quoted in domestic currency. That's the direct quote definition. So therefore this is false.
So 25, 28 and 32.
25,
28 and 32.
25 we discussed, 25 we discussed. 25, 28.
Yes, sir.
Which of the following is not true on futures and forwards? What's the answer?
Sorry, sir, not 28, it's 29, sorry.
29.
Yeah.
You have a short GBP USD position. Which one of the following is the best code to square your position? What's the answer?
B.
Sorry?
B.
D.
B.
The last one.
No, second one.
Second one, B. This one. Why? Others? Do you have any other answers? Do you have any other answers? Others? If not, okay, tell me why this is the correct answer.
So you're short of GBP.
Mm-hmm.
We have to buy GBP at the lowest rate.
Yeah, you are short. So to cover that your position, you have to buy. When you try to buy, you would like to pay the lowest amount. So for that, you select the lowest bid for the offer.
Lowest offer.
Lowest offer. So what is the lowest offer here?
B.
B. What's the figure? Offer figure?
1.5205.
1.5205.
5205.
5305.
So 5305.
It should be 5305. Otherwise, it's other way around. Bid is lower than the bid is higher than the offer. So it is 5305. Correct. So that's the thing that now you asked to discuss that question. Now the problem is I cannot understand why. Whether you cannot understand the question. What's the problem? That's the question I have.
Sir,
What?
can you say next one?
This one.
Yes.
6 month points move from 155, 150 to 90 to 85.
So the previous one answer is B, no?
Yes, correct. Okay, what is the situation here? Sub points are 155 and 150. What does it reflect? USD CAD. What is the base currency? What is the counter currency?
Base USD.
Base currency USD. Counter currency CAD. So points are 150, 550. What does it say when you see this?
So it is
So it's negative.
negative sub points.
This is negative sub points. Okay. When you first thing, that's the first thing that you have to identify. Whenever you see this, you see the bid is higher than the offer, so the points are negative. When do you get negative points? When do you get negative sub points?
When the base currency interest rate are high.
When the base currency interest rate is high. So what does it mean? That greater than this is the relationship. That's correct. Now, $90, $85. From this sub points to this, the market moves from here to here. What happens to this relationship? Has it changed?
No.
No. Still, this is valid. Then, what can cause for this reduction?
So that is CAD increase or dollar rate decrease?
CAD
Increase interest rates,
increase. Yes.
or dollar interest rates to go down, one of them.
So then what is the answer?
That should be B.
B. Dollar interest rates fall.
So 32, please.
32. It's about FRA. The company treasurer needs to borrow 10 million euros for 180 days, 6 days from now. The type of FRA and position he should take in to hedge the interest rate. Okay, what is the risk? The treasurer wants to borrow in future. What is his
Interest rate increasing.
what is his risk?
Exchange rate increasing.
Sorry?
Exchange rate of US increase.
Why exchange rate matters?
No, interest rate
Interest rate
increase.
increase. If interest rate goes up, he will have to pay high interest in future. So to avoid that, what he should do? Buy a FRA or sell a FRA.
So buy.
Huh?
Buy a FRA.
Buy a FRA. Why? What do you do by buying a FRA? What is a forward rate agreement? And how does it work?
You want to fix the rates?
You want to fix the rate. So in a forward rate agreement, you fix the future interest rate. So in this case, in 2 months time, but for a 6-month period. That's why it says 180 days, 60 days from now. So we want to borrow for a 180 days, that means 6 months, but in another 2 months time, we want to borrow in future. So we fix the interest rate for a 6-month period starting from 2 months now. That is the FRA. So okay, and whenever we buy the FRA, what we agree to pay that fixed rate and receive the floating rate. If interest rate goes up, we receive that floating rate while we are paying at a fixed rate. That's the basic concept. But here you have to buy which one?
2 by 8 now.
2 by
8 now.
2 by 8. Why 2 by 8?
Because it's 180 days from after 2 months.
Yes. First figure, this 2 represent when the price starting. So that is in 2 months time. Then the second one gives us when the price ending from today. So it's ending in 8 months from today. So therefore it's 2 by 8, not 2 by 6. Remember, this is, we borrow for a 6-month period, but from 2 months today, sorry, in 2 months time. So therefore from today, the FRA will end in 8 months time. So therefore 2/8 long. That's the correct answer.
So next one, please.
So how to get that 8 months? 8 months thing.
8 months. So that's what, because what is the end date from today of this FRA? We want to borrow for a 6 month, but starting from 2 months. Therefore, altogether period is from today, it is 8 months. If the 1 day value at a risk of, so you can't answer this question because we didn't discuss value at risk.
So in the 30th question, so in the soft points, the rates have gone down also, so we can assume that we can come to that conclusion. No, USD interest rates are falling. We can come to that.
Yes, that's the answer.
No, so by looking at that, that amounts are reducing. Amount is values is reducing. So we can go to that. Can assume that
Whether sub points are reducing or decreasing or increasing.
The amounts are decreasing, so we can come to that conclusion. No, interest rate falling. That's
I'm not sure what you are trying to say.
so it has reduced, no, sir, 155 to 90. So from that, it's we can come to the conclusion that it is USD interest rate.
No. I think you are not. You have not got the point. It's not first thing. It's not decreasing. It's increasing. This is 155 minus. This is minus 90. So points are increasing. That's the first thing. The other thing is, just because of these two figures, or the 155 to 90 is getting lower, whether these rates increase or decrease, that depends on whether the rate appears in the denominator or the numerator. That all thing has to be considered.
So denominator numerator means we use the direct quote and indirect quote. Is it?
How do you get these figures? Sub points. Think about it. How do you get the sub points? What is the equation? Then where the dollar interest rate appears, where the CAD interest rate appears. What would happen if CAD interest rate increases? What would happen if dollar interest rate increases or decreases? Just think about it.
Okay.
Wow. Yeah, so, yes, this you cannot answer. But just to explain, VAR gives you a maximum loss that you may incur during a given period at a given confidence level. So if it says 50,000 at 95% probability level, 1 day, that means out of 100 days, 95 days, your loss would be less. Maximum would be 50,000 or less than that. That's how you interpret it. But there can be a 5% chance that your loss would exceed that $50,000. Sorry.
So next one can you?
34.
Yes, sir.
Which of the following risks are not present in a short USD JPY spot position done today? What is market risk? What is counterparty risk? What is basis risk? What is settlement risk? Out of these four, what are the applicable risk to this trade and what is not? Dollar yen. Sorry.
Is it a market risk?
When you do a dollar yen trade, what is market risk?
Risk occurs due to changes in the market.
When you do exchange rate, do you face any market risk?
We are short now, so
Yes, we are short. Then, is there any risk? When you are short in dollar yen, what are the risks that you face? Is there any risk?
The counterpart risk is not there.
Counterparty risk?
Not there, sir.
Not there. Why?
Because we are not entered to a deal.
We are?
We are not entered to a deal.
What does it say? Which of the following risks are not present in a short, not present, fine, in a short USD JPY spot position done today? How do you get a dollar yen short position? Without entering into a transaction with a counterparty, how do you create a dollar yen spot position? Short or long, whatever. Do we have the market risk when we have a short position? When we have a short position, do we have the market risk? Yes or no? Then what is basis risk? What is settlement risk? What is settlement risk?
It's unable to settle the transaction on time.
Unable to settle the transaction on time. Do we have that in this transaction? What is basis risk? What is basis risk?
So that is changing the basis.
Changing the basis. What is
Point.
basis? What is basis?
The points we are using to calculate the forward rate.
Points we are using to calculate the forward rate. What does it mean by points we use to calculate the forward rate? So go through the handouts, find out the definitions of these risks and see which is available. And I warn you, question number 25 where I started. Okay. So when I ask what is the answer for this question, someone straight away say it's above 11,000. I know why. Because in the 2020 paper, if I remember, let me check. This is the 2020 paper. What's the answer?
Above 11,000.
About 11,000.
So you did this paper, you saw the same question, you said me gave the same answer. You can remember the answer. That's why. Don't do that. Huh? What I have done, just flip the numbers. Interest cost here 7%, dividend payment 5%. In the 2019 paper, interest cost 5%, dividend payment 7%. So all these questions, even the questions that I gave you, sample questions, you will see them in the question paper. I'm not scared to do that. But with a, I might check the same concept. See this one or the previous one. See the same question number 25. I check the cost of carry model, whether you understood it. The same concept I checked with different numbers and different. So even the question number, sample questions or whatever questions appeared in these past papers, you will see the almost same the question, but don't try to answer with or what is in your memory. There will be subtle changes, small changes, and tricky. So that I have to tell you. But you should know the concept. If you know the concept, you can answer the question easily. It won't take time. If you don't know that, only then say you will do a lot of calculations here and come. So I don't know whether there were some questions on of these paper. This one. You might see some of the information is not there to do the calculation and therefore you cannot answer or something like that. But to answer this question, you don't want that. What is the concept? Check in here. What is the concept that I'm going to check here? Or the test. I'm going to test.
Relationship between price, coupon, and the yield.
Exactly. The relationship between price, coupon, and yield. If the price or if the yield is higher than the coupon, it's at a discount. If the yield is higher than lower than the coupon, then it will be at a premium. That's the concept that I'm going to check. So even in this question, I can change 7% to 6, 8.5, 6, 8.5 to 7. Keep the question as it is. See, but go through the question, try to understand what is this. If I ask straight away what is the relationship between this and that, you may answer still. I don't know. However, these questions test that concept in a different manner. But you would see when you see the numbers and things, you have to do some calculations. Not necessary. There may be questions. There will be questions that you may have to perform some calculations, but not all. So all those that duration, coupon rate, maturity, that concept. Then the convexity concept, yield price relationship with the convexity, and this price, coupon, and yield relationship in the cost of carry model and the option premiums and things, forward exchange rate, especially the plus swap points and negative swap points. Same question what we discussed earlier on this. I can ask, just give this 150 on 55, 150 on the interest rates, relationship between interest rates, whether they both interest are same, whether one is higher than the other, or something like that. So get ready for those things. Shall we stop here? You have anything else?
So in the 19 paper, that asset and liability management question, section B.
Section B.
Yeah, section B. That's Roman number 1. C.
Question number
5. 1C. See that interest rate. This one
we discussed this now. We discussed.
We discussed, but I didn't
Sorry.
Can I?
Okay. What is the expectation of the bank when you have negative gap? That's what it asks. What can you infer about expectation of BRC bank on interest rate? What is the answer and why? Can someone explain? We discussed this. When do you maintain a negative gap? What is your expectation on interest rates?
Interest rate to decline.
Interest rates to decline. Anything else?
Sir, can you post the answers for this question if it's possible?
I'll try. I'm not sure. For the part one, it is easy.
Section A, is that possible, sir?
Section A possible, yes. I think so.
I think you had already posted them, sir.
No, that is 20, no?
All right.
Yeah, this one.
This one also, I have a doubt whether I have posted.
I
check.
think
No, sir, no.
Yes, sir.
No.
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 Okay, I'll check it. Not, I will let it away.
You got the 2020 paper and answer, and 2019 question paper.
Only the paper.
Yeah. Yes.
Okay, I'll post the answers. That can be done. Okay, anything else? But I warn you, don't remember those answers.
Sure, sir. So the structure won't be changed, no?
You're not going to change the structure. So yes, this same structure will be there. Yes.
When it comparing with the 2020, this 2019 is a little bit difficult. No, that's mean like
Compared to 2020, 2019 is difficult.
Yes.
Why?
So what about the 21 one? Is this more going to difficult or?
No, there's no. So see, even you compare these two paper 2019 and 2020, same questions will be there here and there. If you do a analysis, say what I can do. See, American options allow for exercise on before option expiration date. I can easily convert this to MCQ. And take some of these questions, say this one, put it there as a true or false. It's not a big thing. So
No,
same thing, same concept. So will be checked, but in a different manner. So therefore, I don't think whether that one difficult or this one difficult. I don't think that it is true. There won't be any.
in 2020 paper in section B, there are more things to write than the calculations. So in 2019, it's calculations are more. So that's what I.
Not really.
No, that's mean in 2019 section B there are 4 calculations and 1 written answer.
No, even the ALM one, you don't have to do any calculations. That's why. That's the thing. So in 2020 paper, 2019 paper, you think you have to do calculations here? No calculation. Did we do any calculation?
No, I mean that numerical things.
But this is again the basic. How do you put in if you don't put if you don't know the how to bucket the assets and liabilities into a proper gap report? What's the point? So that sort of things will be there. Some maybe essay type, some maybe this sort of structured, I think, but mostly expect this sort of structured questions, because that can focus to the point. If I ask just to essay type, you will write whatever come into your mind, whether relevant or irrelevant, so it won't work. You just spend unnecessary time on that. But when it is structured to the point, whether you know,
So in this year also there will be 2 essay type and 3 calculations, no, for the section B.
not something like that. I don't know. There can be 5 questions, no, here. Sorry, 4 questions.
Five, no? In
Five,
section.
sorry, five questions. 5 questions to answer 3 questions. That's the only thing that I can say, because whether it will be a calculation or essay type, that depends. So that's the thing. You are not get ready. You are not studying the subject matter. You are studying the structure or that's not going to work. Study the subject matter. Then whatever the form that you get, you will be able to answer. Yes, please go ahead.
So for the 37 answer is it D? I just have a small doubt.
30.
37.
This one.
Yes, is it the answer is D?
You bought 10 million January 3rd, 2019. It's a Thursday. January 7th, Monday is a holiday in the United Kingdom. Then what will be the settlement date? Thursday, January 7th is the trade date. Then what is the spot settlement date?
Tuesday is it? Since Monday is holiday.
So T plus 2 and holidays Tuesday. Right?
T plus 2, then Friday, Monday. Monday is the settlement date, spot date. But if the Monday is a holiday, then what do you do?
It's a Tuesday. You settle the next day.
Okay, but with that, there was another question.
For the 30.
There was another question on a deposit, actually. Is it in this paper 2019 or no 2020? No, I cannot find. However, if I remember, there was say in a spot transaction, you move forward. Always you move forward for the next working day. But deposit maturities, it's not the same. Just remember, there are instances that you go back. Okay, shall we stop now?
Okay, sir.
For the assignment marks, you are giving not giving separately, no?
No,
Actually,
it will be included into the final marks. Have you all submitted the assignment?
Yes, sir.
Okay. Was it difficult or interesting? That is something to happen in Sri Lanka, so better. Okay, then we'll stop here.
Hello.
Yes.
So I want to make you a special thanks for coming today and conducting us extra class. Thank you very much.
So it's not a big thing, but it's not. You work hard and complete this. That's the, I think, best thing that you can do. And you reflect that wherever you work, what are the things that you learn from this. I hope you learn something. Use that. Not with. I'm pretty sure whether I pass or fail. I don't expect you to fail, but yes, whatever happened, I think you get some knowledge. So use it properly. It will be helpful for you. Okay, all the best then.